Today, we're going to go over international corporate finance. We will talk about foreign exchange rates, how exchange rates affect financing and investment decisions. If you are a multinational firm or a firm considering the foreign investment, you need to consider issues such as exchange rate for sure, worry about political risk from foreign governments. You may be opened up with more financing opportunities from foreign investments. Now I'm going to go over a few common financing choices for foreign investments. The first one is a stock investment. The instrument called American Depository Receipt, ADR. ADR is a type of securities issued by non-U.S. firms in the United States. Once issued, these stocks trade and behave just like regular stocks issued by U.S. companies. Below are some popular ADRs from firms all over the world. So the U.S. investors can buy and trade these stocks in the U.S. in U.S. dollars. Foreign companies from all over the world can issue and raise money, dollars, in the U.S. Foreign companies can also raise money by issuing bonds, which are called international bonds. There are two kinds, Eurobonds and foreign bonds. Eurobonds are issued in multiple countries, but only in one currency, the issuer's domestic currency. For example, Tesla Company. Tesla Company issued bonds in Japanese and European markets. Then this is example of Eurobonds. Tesla raised those Eurobonds in terms of US dollar, the domestic dollar for Tesla Company. Foreign bonds is issued typically in one country and in that country's currency. For example, Tesla issued a foreign bond in European markets in terms of a euro. So which is a type of foreign bond? Compared to the popularity and the restrictions, Eurobond is much more flexible and easy to comply, and is much more larger in the total size. While foreign bonds are typically very restrictive. You have to follow all these regulation requirements in order to raise foreign bonds in that country's currency. Eurocurrency is a money savings deposit in a bank outside home country. Euro has not necessarily means Eurozone or Eurocurrency. For example, you have a deposit denominated in euro. And in foreign bank, it is just called euro. Another example, US dollar denominated deposit in a Singapore bank, it is just a euro dollar. Right? Have you heard about adjustable rate mortgage, where the interest rate is not fixed? Or have you heard about floating rate instruments, where the instrument rate is linked to some other fundamental interest rate? I'm going to talk about LIBOR, London Interbank Offered Rate. This is a very important interest rate and used as a benchmark interest rate for a lot of floating instruments. So originally, LIBOR is just the loan borrowing rate for the major banks in London for covering the bank's capital reserve requirement for overnight borrowing. Over the time, this became such popular and important. It now evolved into 5 currency and in 7 different maturities. In addition to original overnight, has 1 week, 1, 2, 3, 6, and 12 months. Among these LIBORs, one of the most commonly quoted is the 3 months US dollar rate. Gilts is the government bonds issued by British and Irish government. That is just a UK version of the US Treasuries. Swap comes handy because they allow you to swap one type of interest rate, floating rate, for a fixed rate payment or vice versa. Or you can swap type of one currency with another. So these are the common financing choices you may have if you go to invest in foreign markets. Now let's move on to exchange rates. This exchange rate quotes for a few currency on May 18, 2018. So I have exchange rates in two formats. One is in US dollar, the other is per US dollar. Let's take a look at some of the currency quotes. For example, Mexico peso. One Mexico peso equal to 0.05 or 1 US dollars. And each US dollar is equivalent to 19.9522 Mexico peso. Japanese yen. One Japanese yen equal to 0.00903 US dollar. One US dollar equal to 110.75 Japanese yen. Let's see one example. Suppose you plan to exchange $1,000 into Japanese yen, and exchange rate is 1 US dollar equal to 108.21 yen. So how much will you get? 1,000 times 108.21. So the answer is 108,010 yen. Another example, during your visit at Japan, you see a nice souvenir that costs 8,888 Japanese yen. If the exchange rate is the same, how much does it cost in US dollar? In this case, we will use 8,888 divided by the exchange rate. The answer will be $82.14 US dollar. As you probably noticed, exchange rate typically quotes in US dollar. Sometimes it is convenient to find out the direct exchange rates between two non-US currency. For example, what is the exchange rate between Mexico peso and euro? The implied exchange rate between the two currencies that are both quoted in a third currency is called cross rate. Below is one example. We have quotes on euro and Swiss franc, both in US dollar. Now, what is implied cross rate? What we want to do is divide two exchange rates quotes. So we got the cross rate between euro and Swiss franc is 0.5 euro per Swiss franc. In international transactions, some of the trades take place immediately, and some will to be waited and to be executed in the future. So the former one is called spot trade, and the later is forward trade. In spot trade, the exchange rate used is the current exchange rate, so this is called spot rate. In the forward trade, the contract uses a forward rate. So forward rate is exchange rate which is agreed on today to be used in the forward transaction in a forward contract. Let's take a look at examples of spot rates and forward rates. I have two quotes for Japanese yen and Canadian dollar. All these quotes are quoted as US dollar equivalents. Take a look at Japanese yen. For the spot rate, 1 US dollar equals to 105.05 Japanese yen. For 3 months forward rate, 1 US dollar equals to 107.75 Japanese yen. So the value of the US dollar increase with respect to Japanese yen over 3 months period. On the other hand, Japanese yen, the value of Japanese yen is depreciating over 3 months term. Now let's apply to Canadian dollar. The spot rate for Canadian dollar is 1 US dollar equal to 1.2102 Canadian dollar. The 3-month forward rate is $1 equal to 1.21 Canadian dollar. So the value of US dollar depreciates over 3 months period. This implies the value of a Canadian dollar, on the other hand, appreciates over the 3 months period. Next, we are going to discuss what affects exchange rates in the future. So the relationships are summarized in several parities, and the first one is called purchase power parity. Purchase power parity has two versions: absolutely purchase power parity and relative purchase power parity. Absolute purchase power parity says the price of one good should be same whether you buy in one currency or another. For example, an ounce of gold should cost the same amount of money whether you purchase in the US or Europe. But we do know in reality, it is not true for a lot of goods. For example, if you want to buy a Tesla Model 3 car from Europe, right? Then you have to pay a lot more than if you purchase here in the United States. This applies to a lot of luxury goods, and they often to have importing taxes or tariffs, so this makes them more expensive, right, to buy from foreign markets. A few things which make purchase power parity difficult to hold: things like transaction costs, border tariffs, or just a customized version across different markets. So for most goods, absolutely purchase power parity does not really hold in practice. I here listed a few of different goods. I want to ask you, which one of the following is less likely to violate the absolutely purchase power parity? Another word which is more likely to have the same price across different countries. First, a BMW automobiles, an iPhone, luxury bottle of perfume, a gram of gold, a pound of salmon fish steak. What's your pick? A gram of gold, that's right. If we accept the fact that absolutely purchase power parity does not really hold in practice, we still may be interested to find out what affects the exchange rate in the future. Will they stay constant? Will this cost more money for me to buy a Tesla Model 3 6 months later? So the exchange rate change constantly, right? So what influence exchange rate change in the future? So the relationship summarized in relative purchase power parity. It says expected exchange rate in the future depends on the spot rate, the inflation between the two countries. The strength of the currency is negative or inversely related to the inflation. The high inflation rate will make your currency much weaker compared to a lower inflation rate. Take a look at one example. Canadian spot exchange rate is 1.18 Canadian dollar per US dollar. US inflation is going to be 3% every year. Canadian inflation is 2%. So before we apply the purchase power parity, so take a moment. Which country has a higher inflation rate? US 3% is higher than Canadian's inflation. So which currency is weaker compared to another one, right? High inflation reflects a weaker currency. So US currency is going to be weaker compared to Canadian dollars. So take a look at now the actual number. So let's apply the purchase power parity formula. 1.18 spot rate. Foreign currency is Canadian dollar, 2% inflation, US 3%. So we got 1 year later, exchange rate expected to be $1 equal to 1.1682. So it is decreased from 1.18 now to 1.1682. The value of the US dollar is depreciating. I'd like you now pause a moment, practice on this PPP question. The next important relationship is called interest rate parity. So in forward transaction, the forward rate is used, but the payment usually is delayed until sometime in the future. So thus the interest rate of holding the payment in one currency or another matters. Okay, so this is why we have this interest rate parity. So interest rate parity depends on the spot rate and the rate of interest in two countries. We have two versions, exact form and approximate form. To find out forward rate in 1 year term, we use exactly format. For other terms, for example, half year or 3 years, we will use approximate format. Let's look at one example. The spot rate between euro and dollar is 0.8 euro per US dollar. The rate of investment is different. If you're holding the currency in the United States, 1 year later, you earn 4%. If you're keep your currency in euro, you earn 2%. How does this affect our forward rate? We want to use forward rate 1 year later, so we will use exact formula. F1 divided by 0.8 spot rate equal to 1 plus the 2% in euro over 1 plus 4% in US. So this gives us the forward rate is 0.769. So each 1 US dollar is equivalent to 0.769 in the future. So what if the quoted forward rate in 1 year is other than 0.769? In that case, this provides an opportunity to make additional profit. If the quoted exchange rate is other than 0.769, for example, 0.7, so this creates an opportunity of arbitrage. Investors can come in, buy low, sell high, make additional profit. Eventually, price will move up to 0.769. I'm going to ask you to pause and practice two questions. The first one asks you to find out the 1 year forward rate. So remember, you want to use exact form. The second question asks you to find out the 3 year forward rate. Then, in this case, you may use the approximate format. Is it clear? Do you want to use which form of the formula to find out forward rate? 1 year exact form. Other terms, approximate form. With time goes by, the forward rate will get close, converge to the spot rate. So the current forward rate is going to be an unbiased estimate of the future spot rate. So this is called unbiased forward rate. If they are different, either the forward rate is higher or lower, the investor will come in and trade, move them to the same level. List all these interest parity we learned so far. We are able to derive another one. It's called uncovered interest rate parity. And put all the four together, we are able to derive a very important relationship. It's called international Fisher effect. The international Fisher effect tells us whether you invest domestically or another foreign country, you should get the same real rate of investment. Make sense? Makes sense. You have again two forms. One is exact form and another is approximate form. We will use international Fisher effect to guide us in international capital budgeting decisions. The approach we're going to discuss here is the foreign currency approach. We will use 3 steps. Step 1, use international Fisher effect. Convert domestic required rate of return to foreign required rate of return. Then we find out net present value in foreign currency. Lastly, convert net present value to US dollar, use current spot. Using current spot rate. Lastly, convert net present value to US dollars using spot rate. Let's take a look at one example. Your company is looking at a new project in Mexico. The project will cost you 9 million pesos. The cash flow will be 2.25 million pesos per year for 5 years. The spot rate is 10.91 pesos per dollar. The risk-free in US is 4%, in Mexico 8%. The dollar required rate of return 15%. Should the company make the investment? Let's first go over procedures. Number 1, use foreign currency approach. We will use exact international fish effect formula to find out discount rate of investing in Mexico markets. Step 2, use cash flow informations. Use cash flow keys. We're going to find out net present values in Mexico peso. Lastly, we're going to convert net present value into US dollar use spot rate. Here are the detailed solutions. The rate of investment in US is 15%. The risk-free rate in US is 4%. In Mexico, it's 8%. So we plug in and rearrange. Get this Mexico rate of return is 19.4231%. Then we use cash flow keys. Enter initial cash flow negative 9 million pesos. Cash flow 1, 2.25 million pesos for 5 years. Interest rate, use the Mexico rate of returns, compute the net present value. Lastly, divide by spot rate 10.91 to get NPV. So this is going to be a negative NPV investment project. So your recommendation will be reject this proposal. You may use approximate international fish effect to find the discount rate, but in terms of such question in $1 million, this will cause rounding issues. The answer is still similar, does not change our conclusion. I now want to ask you to pause and take out your financial calculator and papers, practice this capital budgeting questions. So this lecture, we have talked about the ways of raising money in foreign markets, exchange rates, several different parities, international fish effects, and how we make international capital budgeting decisions. So that's all for this lecture.